almost generous. So you can see that technology had shown how public capital could translate into scale and credibility. Sarah had watched closely, convinced her own company as well to go through with this, and they could follow that arc as well. So back then, founders like her could set what is ambitious price bands, expect the market to meet them halfway. But things had shifted. So now, as her advisors laid out valuation scenarios, they also spoke of resistance of large mutual funds that were pushing back, questioning assumptions, demanding what were clearer paths to profitability. So, this whole market, as Sarah realized, had grown sharper. So, she flipped through recent IPO data, and in 2025, over 100 companies had hit the market, raising staggering sums. So, listing day gains were still there. It was enticing enough to keep retail investors hooked. But beneath that surface, churn was evident. So, what was this? Stocks that surged on debut didn't always sustain the momentum, and many were being sold within days, so that they promised traded for quick profit. And that's not all of it. So all of this, of course, unsettled her. So she didn't want the company to become what was just another listing day headline. So her CFO pointed to what were cautionary tales. And these as well, like say Paytm, for example, Paytm had once commanded enormous attention, but it had struggled under the weight of expectations. So that lesson was hard to ignore. So liquidity could create hype, but only fundamentals could sustain value. At the same time, the structure of the IPOs itself seemed to be evolving. So, a growing share of these offerings were offers for sale. So, early investors exiting rather than companies raising fresh capital. So, Sarah's own cap table reflected that tension. So, her earliest backers were eager for liquidity. They they had, of course, waited years for this moment, but she wondered what signal it would send if most of these proceeds bypassed the whole business itself. So, would these investors see it as maturity? Would they see it as an exit door? So, beyond spreadsheets and strategy decks, there was also this mode of the market that had to be considered. So, India's growth story as well, and India's growth story as well remained like that. It remained, let me see what it was, it remained compelling. So, consumption was rising, capital continued to flow. There was even talk of the economy scaling to say $5 to $6 trillion in the coming years. Yet, alongside that optimism, ran what was a quieter caution. So, investors were no longer indiscriminate. They were choosing what was more carefully, rewarding resilience over rhetoric. So, if she priced, say, aggressively, she might secure what was a strong debut, but risk what was a post listing slide. So, if she priced, say, conservatively, she might leave money on the table, but also build trust over time. So, this decision wasn't just financial, it was also philosophical. So, what kind of a public company did she want to become? So, late that evening, she closed her laptop and she stepped back from the numbers. The market, she realized, was asking her to be credible, to show not just ambition but also endurance. And perhaps that was the real shift. The IPO dream that hadn't dimmed, it had simply grown up. Now we see the next example, which is of a stockbroker. Let us say this name called Shaker. So Shaker had seen cycles come and go, bull runs that felt like destiny, crashes that felt like betrayal. So, sitting behind a desk which was worn smooth by decades of elbows and ink, the stockbroker watched India's IPO market, and this was with a very familiar mix of curiosity as well as caution. So, the frenzy was back. New names, new narratives, new money. But what were the patterns? Those hadn't changed. So he remembered how eagerly investors had chased stories, how Zomato, for example, had arrived with fanfare, stumbled, surged, and then cooled. So, how Paytm had promised the future only to falter under the weight of its own valuation. So, even the Mighty Life Insurance Corporation of India, which was a household name, had struggled to justify what was its aggressive pricing despite over subscription. So, Shaker had learned that the market is not an unforgiving judge. So, you could see that in private markets as well. You could tell a story and you could also find believers. So, in public markets, for example, numbers had to do all of this talking. So, they had to make sense quickly. So these days you see that Shaker noticed the crowd was younger. So first time investors chasing listing day gains, scanning the social media for the next big pop. So they came in with a lot of confidence, sometimes with borrowed conviction. So he didn't blame them. So access had been democratized. The gates were open wider than ever before, but access, he knew, wasn't the same as understanding. So he leaned back, he thought of the companies that had quietly done well. So the ones with, say, steady cash flows, clear plans and businesses that could be explained without jargon. So these weren't always the loudest of stories. You don't have to be loud, you can still be soft and silent as well, but gently telling the tale, as I would put in my own inputs. And these were the stories that endured. So, the new market, for all its obsession with narratives, still rewarded what is known as discipline. So, discipline is the key thing I would say here, as my own take on that from my personal perspective. So, there was something else he noticed too, which was a shift in character. So, professional management, independent boards, audited discipline, all of these are signs that the market was maturing. So the old promoter driven opacity was giving way, and this is going like very slowly to governance. This could withstand scrutiny as well. So that he believed would matter more than any hype cycle. Still, Shaker remained wary of this fine print. So, as Shaker says, as for an example, as we would say, too many IPOs, he felt it will be like exits in disguise. So, if you say private equity cashing out at peak sentiment as well. So, this is not always a bad thing, but it is something that you need to read carefully. So, say if a company doesn't need capital, what exactly was this listing for? A class listing for. When you're listing, for example, say a class or an online class, you give a listing, you give an advertisement in a website or something like that. you could see that he often found himself returning to a very simple thought, and that is that an IPO wasn't the end of a journey. So it was a beginning of what is accountability. Accountability is everything, as I would say, it is almost everything. So now we see that if you put too high a starting price, then what would happen is the company would spend years trying to grow into its own promise. So the best opportunities, as he told his clients, as he told his, say, his students, all of that, weren't always at the opening bell. So sometimes what you need to do is keep your patience. So patience was the real edge. So if you missed the IPO, there was always another chance. So once this noise settled down, then the price found its truth. So numbers flickered, stories shifted, and somewhere between all of that lay quiet, lay value. I beg your pardon, that was lay value. So numbers flickered, stories shifted, and somewhere between them lay value. So this was quiet, this was patient, and this was waiting to be understood as well. So not every investor he knew needed to chase it directly. So for many, the wiser path would lay in diversification. So in steady compounding rather than speculation. So the market would always tempt, so that was its nature, but survival and success would belong to those who could see past the story. Now we'll see more of this in the next part. Stay with me and don't go away. I'll be back in 2 minutes.